Over the last year, we've seen market changes that we haven't experienced in decades. We've seen the impact of the war in Ukraine, markets have reopened since COVID, and rising demand has been met with limited supply, which means that inflation has risen sharply across the world. So against this backdrop and looking forwards, is a recession inevitable? And as behaviours and policies continue to change, what does this mean for investors? Our Chief Economist and Chief Investment Officer share their thoughts.
The last time inflation was this high was 1981.
Food and energy prices are at historic highs around the globe.
Inflation in the UK has reached its highest level in 41 years.
2022 was marked by extreme volatility in interest rates as inflation surged. But thankfully, investors have moved from denial to acceptance when it comes to rates. In fact, we think expectations for rate increases in 2023 are now much more realistic. And this will allow that volatility in interest rates and fixed income to subside and provides a more stable footing for markets more generally.
Going forward from here, we do think inflation is going to fall back. First of all, commodity prices are coming off, so we've seen oil prices begin to fall back. The other factor on the good side, which is very important, is that the bottlenecks that we've seen, the supply chain problems, those are beginning to ease now. But we will be looking for another factor as well next year. We do believe that part of that slowdown in demand will mean that the labour market will begin to ease. And of course, the labour market is very tight at the moment. Wages are rising, there are lots of skill shortages. As the economy slows down, we believe that unemployment will begin to increase, and that will tend to cap wage rises. So in order for inflation to come down on a sustainable basis, that's really what we need to see. We need to see the labour market weakening.
The labour market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
We've seen interest rates rise around the world in 2022. The Federal Reserve in the US has really been in the vanguard of that and has been tightening quite aggressively. They really stepped up the rate with which they're increasing interest rates. In Europe, the central banks have been a little more hesitant. So the Bank of England and the ECB have been a little bit behind the Fed, and they've been more cautious because they've been more concerned about the impact of their actions on the economy in terms of growth and unemployment. We expect them to be catching up with the Fed as we go through 2023 because their inflation problems are quite severe, so they will actually need to take more action.
Deglobalisation creates conditions for greater divergence between different regions and markets as economies recover at differing speeds from the challenges of 2022. So, for example, in emerging markets, a number of central banks were much more preemptive in raising rates than their Western counterparts, putting them in a much more comfortable position as we head into 2023 and providing us with opportunities in emerging markets.
The worst is yet to come. The Bank of England believes the squeeze on our living standards will be so severe that it's forecasting a recession.
We see significant risk of recession in the United States as the Federal Reserve acts to bring inflation under control. And this does pose a challenge to corporate earnings. However, remember that some of the best opportunities for equities occur in the midst of recessions. Markets always move ahead of the economic news. And in fact, I would say that you should avoid looking at the newspaper headlines and focus much more on valuations.
The cost of getting this better inflation outcome will be a fall in GDP. We think that the US economy will probably contract by about 1% in 2023, and Europe will probably contract by about 0.5 to 1% as well. So quite a slowdown, not as bad as the great recession that we had in the global financial crisis, but still quite significant. So people will really notice this. From an investor point of view, it's a bit of a mixed blessing because the recession will help bring inflation down, which means that interest rates can start to come down and markets and investors will begin to anticipate that. So investors are going to have to be quite selective to find the areas of the market that are not hit too badly.
Russia has invaded Ukraine.
Overnight, the Nord Stream gas pipeline, which connects Europe with Russian gas, was damaged in an apparent sabotage attempt from Russia.
We do believe that there is a new world order forming in the world economy, and this has been largely caused by the conflict between Russia and Ukraine. Countries around the world have aligned themselves differently with the Russian side and with the NATO side over Ukraine. It's created what we've called a fault line in geopolitics. And the real focus of that has been between the US and China. So obviously the US is a leading member of NATO, clearly on one particular side of this. China has taken a position of what they call pro-Russian neutrality. And China, of course, is also supporting Russia through buying Russian oil. We think this could create more tension between the West and China. We've recently seen President Xi and Joe Biden meet in Bali at the G20 meeting. They seem to have a good meeting. And it does seem that China could be a favourable influence over Russia.
The war in Ukraine has laid bare our reliance on Russia for energy. And faced with the cost of living crisis, a number of governments have had to backtrack from some of their commitments to the energy transition in the short term. But make no mistake, the strategic imperative for the energy transition is as strong as ever, because it is no longer just a climate problem, it is also a security problem, because we can't be reliant on powers that are not on our side for our energy.
2023 should see a hard landing for the world economy, a global recession. 2023 will also see inflation come down, and to the extent that that means interest rates can come down, 2023 should be a much better year for the markets.
What are the risks for 2023? Well, look, we've been through a war, a global pandemic, an inflation problem, aggressive rate hikes. I think at this point there's potential upside risks for 2023, particularly if the Federal Reserve is able to engineer a soft landing. The key thing to watch is the direction of inflation. The more inflation falls, the more room for manoeuvre they will have, and the more potential there is for markets to move higher.
So looking ahead, we should expect a more active fiscal policy, a focus on inflation instead of growth. And a recession doesn't necessarily mean an end to opportunities across all asset classes. And as to whether we're in for a soft or a hard landing, that's still up for debate. Thanks for watching.